Ladies and gentlemen, boys and girls, children over the age of 18, this is your main man Tez, as well as Travis, and we are your favorite LOs. Today's topic, we're going to talk about conventional loans. We're going to talk about the little nuances with conventional loans and try to give you a quick rundown of what entails to get a conventional loan. So go ahead, grab that pen and a piece of paper and your favorite beverage, and we'll be back in a second to break down conventional loans. See you in a few. All right, ladies and gentlemen, welcome back. And as we said in the intro, we're going to talk about conventional loans and kind of give you a quick rundown of what entails to get a conventional loan and what is all, made up of a conventional loan. So I'll just give a brief intro of it, Travis. So conventional loans, also known as conforming loans, is simply basically loans that meet the requirements of Fannie Mae and Freddie Mac, which are government-sponsored enterprises that purchase these mortgages from lenders to sell them to investors. The difference between non-conforming and conforming is basically those guidelines being met that Fannie and Freddie Mac set out in that regards, right? So that's kind of like the gist of what a conforming loan is, but we're going to get into like the different nuances. Travis, I want you to talk to the people about the down payment when it comes to the conforming or conventional loans, so that way they kind of get an idea of what entails with that. So take that away.
I'm glad you started me with that because one of the biggest misconceptions that we run into on a day-to-day basis as brokers is this concept and this idea that a conventional loan, being the standard product, requires a 20% down payment. Okay, that's not the case. All right. Now, as always, anytime you purchase with less than 20% down, you may be subject to mortgage insurance, PMI, private mortgage insurance, if we're dealing with a conventional or conforming loan. Now, down payments, 3% down is a entry spot for a conventional buyer nowadays. Okay. Now, there are always going to be certain requirements that need to be met to go to 3%. However, what we're finding, Ted, you can tell me in your market, I'm seeing about 75% of my home buyers are qualifying for that 3% option. Okay. Now, doesn't mean that it's going to be the best priced option, right? But oftentimes, especially with first time home buyers, those programs can be amazing, 3% down. Discounted mortgage insurance if you, take online, like an online class that Tez and I can provide you, things like that. But the first myth about a conventional loan that we just have to debunk is this idea of 20% down. Okay. We're working with a handful of lenders now that are doing 3% down with sometimes a 2% grant that will cover 2% of that 3%. So you're getting in with a conventional loan with 1% down. And again, those are crazy specific programs that we would love to share with you in an offline conversation, and make sure that you do fit in that window. But I would say right now, Tez, correct me if you're seeing a lot different. I would say that right now, if I took all of my conventional down payments and I lumped them together and averaged them, I'm seeing maybe like 5.5% down is my average down payment. A handful of people do 10, handful of people do 5, but a great majority are now doing 3%, taking full advantage of the flexibility that Fannie and Freddie is now providing for those home buyers.
No, yes, that's about on par with that, and we're seeing a lot of success down here with using that 3%, especially when it kind of rolled out, and we'll get into that in another video, folks, because in order to get the 3%, there are certain guidelines, like I said, that you have to requirements that you have to meet to get to that. But for those clients that do meet those guidelines, we take full advantage of the 3% in regards to that for those clients. The only thing that I would add is, folks, this is specifically for single family residences, your first homes. When you get into the down payment, when it comes to like a second home or an investment property, or if you're trying to get an adjustable rate mortgage, the down payment will fluctuate or will have a hard number that needs to be met. But when it comes to your, primary residence, your first home, that's kind of what we're seeing in that regards. So yeah, that's the only little tidbit I would probably add, so the folks don't think like, hey, I want to buy a investment property with 5% down or 3% down. Nah, that's not that's not something that's gonna happen. But yeah, I will jump in regards to, and it's kind of funny the transition into it, into the private mortgage insurance. So folks, as Travis was saying, with the private mortgage insurance, it comes with the loans that don't have at least 20% down when it comes to your down payment. So, private mortgage insurance is basically mortgage insurance to protect the lender should you default on the property, right? And what Travis was saying, that it's kind of based on different factors, but the biggest factor is going to be your credit score, right? So with all conventional loans, you have to have at least a 620 credit score in order to qualify for that loan. So obviously, the higher the credit score, the lower your private mortgage insurance is going to be. And that's going to actually be into your monthly payment, right? So it'll be principal, interest, taxes, insurance, and your PMI, right? So that'll all be in one payment for all of those loans that have less than 20% for the down payment. Now, talk to your trusted loan advisor. Give myself or Travis a call, and we'll basically walk you through as far as like what that looks like for the clients, like, because like we said, credit score is the biggest factor, one of the biggest factors in regards to your private mortgage insurance. So whatever we can do to get that credit score up, we'll walk you through that, so that way you're not breaking the bank when it comes to that PMI, ladies and gentlemen. And then also, obviously, PMI does come away with conventional mortgages. So when you do get to that 80% loan to value threshold, you can request that the private mortgage insurance come off of your actual mortgage. And then at 78%, it will automatically come off. But it doesn't automatically come off at 80. Once you get that 20% equity, you have to request it to be removed. And you can simply do that by providing like a new appraisal. If the appraisal amount shows that your loan versus the house is at 80%, then you can then submit that request. Otherwise, the lender is just going to base it off of what was appraised when the home was actually purchased. So keep in mind to always pay attention to your market in your area, so that way you know if that's something that you have to jump on in that regards. But Trav, if I missed anything, please let the folks know in regards to PMI.
PMI having it removed. I think we've touched on this broadly in a couple other videos. Don't ever let someone tell you that it's going to be the easiest process. It's just going to, you send a letter in and everything gets taken care of. The lenders and the servicers are going to drag that on as long as they can for you. Okay. A lot of people have a lot of equity in their home right now. A lot of my 3% down purchasers from 2 and maybe even a year and a half ago are having their mortgage insurance removed right now. I purchased my last home at 3% down about 2.5 years ago. I no longer have mortgage insurance. The servicer sent out a local expert to appraise my home for a couple $100 and had that removed. So be prepared to go through that process. It's not a terrible process, but it is a process. Make sure that we're understanding that, talk to those trusted real estate advisors, right? See if they can give you an idea of what your home is genuinely worth. Let's not use those websites that we won't name to tell you how much your home is worth. Let's use trusted advisors. Okay. I want to talk to you guys a little bit about the difference between conventional loans within conventional loans. And by that, meaning Fannie, Freddie. All right. So, one of the most confusing things for me as I got into this industry was that there wasn't just like one set of guidelines for a conventional loan. Like oftentimes you see with some of our government loans, your VA, your FHA, your USDA, a lot of times those are very black and white. Conventional is a little bit unique in the fact that they look for particular sets of qualifications. Okay, so if let's just say, for example, someone has a lower credit score, in order for that loan to work, we might have to have a higher down payment. Many times, conventional, whether it be Fannie or Freddie, they look for what's called risk layering. Okay. So low credit, low assets. You got to have something there that we can take to the underwriters and say, this is why this person is a good client. Okay. So that's why we tell you how important it is to have a trusted mortgage advisor, because there is no one cookie cutter answer on credit score, debt to income, loan size, loan to value, right? Or, how much equity you have in your home. That's the hard part about the conventional loans. I've had files in front of me where I've expected them to have problems, and because we have some good factors underlying, we don't have any problems. And then we've had clients that have come to us from other lenders who have been told, "Hey, I see that you have 10% down. This isn't going to be a problem," but then they run into problems down the line. Okay, conventional loans are one of the most misunderstood products, even by loan officers, and that's just like the hard truth, if I'm being honest. Yes, there are high ceilings and like hard lines when it comes to certain things like debt to income. For example, conventional loan debt to income, uh, they're going to want to keep you under 50%. Okay. And it's pretty much bar none. All right. But that doesn't mean just because your debt to income's at 47% that you're going to get approved for that conventional loan. And I don't say that to discourage anyone, but I say that to encourage you to reach out to people who can help you and who can truly look at your scenario, right? Because as we are entering in the most important transaction of our lives, and many of us only buy two, three, maybe four homes in our entire lives, it amazes me how many people might just trust an online lender, or the same person that took your deposit at your bank, right? And that's not to say anything badly about those people. I worked at a bank before, but keep in mind that the ins and outs, the deep dark area, you need someone there to be your light.
No, that's awesome. That's awesome. I'm glad you touched bases on that, and I think that kind of transitions into the little last bit that we want to talk about, and that's the loan size. And I'll take it from here with that, Travis. So, ladies and gentlemen, the loan sizes is pretty simple. They're determined by the Federal Housing Finance Agency, so the FHFA. You just simply Google it; it'll bring it up. But there are loan limits to these conforming loans that is pretty much standard across the board. So right now, for a single family residence, the standard is the conforming limit is 726,200. Now, ladies and gentlemen, that is a single family residence, right? Now they do have caveats for what they would call high cost areas. So places like Alaska, places like Hawaii, certain counties in California, and I believe New York. But that agency website will tell you where the high cost areas are. Their single family conforming limit is 1,000,000 89,300. Right. And ladies and gentlemen, that is a single family residence. Now, each conforming limit differs from a single family to a duplex, triplex, and a quad, right? It's that all they have different loan amounts. So that website will tell you exactly what the conforming limits are for all of those unit types, right? So that kind of breaks down the conforming loan limit, and it's just a simple thing, ladies and gentlemen. It's just like you just always want to know, because the minute you break that conforming limit or go above it, now you're going into a non-conforming loan, or aka a jumbo, and we'll probably do a video about jumbos here soon. But that's just so you know, hey, this is the loan limits, and you want to stick to that in regards to a conventional mortgage. I don't know. Is there anything you would probably want to add in regards to the loan limit, Travis?
No, loan limit, very, very straightforward. It's kind of funny because every year they release those numbers. And I feel like now I can gauge how old I am and how long I've been in this industry based upon the conversation that happens in the office whenever they release those loan limits. Like, we always find ourselves being like, I remember when the loan limit was I mean, isn't it crazy how things have changed over the last few years, especially? So I think, Tez, you hit it on the head. We definitely are going to have to dig in a little bit on some of these non-conforming loans for people, because just because they're not a conforming loan doesn't mean they're a bad loan, right? A lot of times people relate, non-conforming to like subprime. Those aren't the same thing. Okay, so I think that we probably have one set up on the tee for us for that next video. Obviously, we're always willing to take everyone's feedback. So if there's something about those other products you'd like to know, hit us with a comment, hit us with the like, the subscribe, ring the bell, so that we can help you with what you need.
So he stole my thunder, ladies and gentlemen. So as always, if you found this to be helpful, do what he said. Oh man, I could have swore I got this point right. Do what he said. So then that way we can make sure that we always give you the knowledge you need to get the D. But with that being said, my name is Tez. That's Travis, and this will wrap up this video on conventional loans. Until next time, folks. See ya.